The mic is on. Can we hear you online okay? Yes, no? We're good? Perfect. All right, well, let's go ahead and get started. So again, thank you all so much for joining us tonight for our home buyer seminar and talk about getting the keys to home ownership. Like I said, the market is still great here in South Florida. It's a great time to buy. Home ownership is something that we're all very passionate about tonight. And we'll be talking about, you'll be well informed before you leave here tonight. Again, my name is Adam Nark here. I'm the sales manager and broker associate here at Treasure Property Group. And just so you know, Treasure Property Group, we are your local real estate brokerage where we believe that families are serving we're families serving families, and we believe that your trust is our treasure. So we specialize in residential, commercial, investment real estate, property management. We do it all. And we are people and families living right here in our community. We work with the local school board. We work with local nonprofits. So we're actively involved here in the community. I'm also a Palm Beach County native, graduate of FAU. I've been licensed for over 16 years. I teach licensing courses. And I will tell you this, the one thing that I've heard more than anything else in my 16 years in real estate from people is I should have bought a home back then. Whether back then was a year ago, 3 years ago, 5 years ago, 10 years ago, whatever it is, I hear that more than anything else. And it's so true. It's always a great time to be buying in real estate. So we'll be talking about that tonight. So, and again, we'll be talking about a little bit about what is the home buying process, owning versus renting, what exactly is involved in the real estate transaction, what we do as real estate agents here. We'll also be talking about financing from our friend Hector from Preferred Rate Mortgage. We're going to talk a little bit about some of the financing programs that are available out there, including the Hometown Heroes program, where you can qualify for up to $35,000 in down payment assistance. We also have Giselle with Seawood Credit Repair, who's just going to talk about credit and just things that you can do to improve your credit to get yourself in a better position to purchase a home. And then we'll do a little Q&A session for everyone after the presentation. So what are some of the benefits in owning a home? Well, investment appreciation. South Florida, the real estate market is hot. Like I said, I just saw our latest market stats, and housing prices continue to rise. Okay, like I said, you know, I hear so much I should have bought back then. I have a friend of mine. She bought her first home about 4 or 5 years ago. It was in the Northwood area. She paid $175,000 for the home. She just sold it last year for $450,000, and she put maybe $23,000 into it. Because again, the appreciation has just been so great in this area. Another good reason to invest in real estate is leveraging. Once you build some equity in your home, you can get an equity line. You can leverage that to invest in other real estate. Investing in real estate is a great way to help with retirement or possibly paying for your kids' college, things like that. So again, these are all things that we're also here to help you out with. So of course, you have great tax benefits. You're saving money. We'll talk about that in a moment. More space, your security, and just pride of ownership, you know, just owning a home, you know, no matter how great, if you're renting, you know, I've been to some rentals where some people have just made it a wonderful home, but it's not the same as ever yours. When you own a home, it's your home, you know. So it's another great reason to buy in real estate. Now there is some downsides in owning real estate. Of course, you got those monthly mortgage payments, you got your property taxes and homeowner insurance and maintenance and upkeep and the utilities and the HOA fees. And yeah, we hear the stories that, oh my God, that stuff is going up and up. And yeah, it's a little bit of a commitment. But let's talk about this for a minute, okay? So first of all, with the commitment, the decreased mobility, the trade-off of that is the pride of ownership, because again, you own it and it's yours. And also too, with the decreased mobility, the great thing about this area is we're very transient. If you need to go somewhere, it's very easy to rent that property out down the road. I see a lot of people do that. So it is a commitment. It's not the commitment that you think it is. But let's talk about all these other things for a moment. Okay. Yes, these things are going up every year. Yes, you're going to have a monthly mortgage payment. Yes, we know, we hear the stories, taxes, insurance, these things are going up a little bit every year. But think about it this way. Okay. You either have to pay this or you got to pay rent, right? Because everybody's got to live somewhere, right? Well, right now, do you know that in our area, rent prices are increasing an average of 8 to 10% annually? So what does that mean? Well, that means if you're paying $2,700 a month in rent right now, next year that same place could cost you $2,900 a month. And the year after it could cost $3,200 a month, and so on and so forth. Okay. I promise you that no matter how much this goes up, it's very small compared to how much those rent payments are going up. See what I mean? This is very minuscule. Plus, two, you own it. You're building equity. Okay. And also, too, you know, when it comes to like your property taxes, you know, you can file for homestead exemption, so that doesn't go up as much. We'll talk about that a little bit. So, but again, just far better than renting. So, again, when is now buying a home may not be for everybody. You know, if you're only going to keep it for a short time, may not be the best. Yes, flipping properties is good, but not all properties are good to flip. If you're not sure that you're going to like the area, I tell people if you're new to the area, if you're moving to somewhere, you might be better off renting for 6 months to a year while you get a lay of the land and you know where you want to be at. Okay. Again, you want to make sure that you have that steady income coming in, that you have enough for the down payment. And really, you just want to make sure that you're able to make that monthly mortgage payment. Because no matter how much you love a home, the moment you struggle to make that mortgage payment every month, you'll fall out of love with that home really quick. So these are things that we work to make sure that you're comfortable with that payment. It's something that, you know, you're going to be in a good financial position to handle every month. So, again, what does it take to qualify for the loan? Capacity, capital, character. Again, I'm just going to let Hector and Giselle talk about that in a little bit in a lot more detail. So when it comes to selecting a realtor, not all licensed real estate agents are realtors. Okay. We are all realtors here. To be a member of the National Association of Realtors, you have to join, you have to pay your dues, you have to adhere to the code of ethics, which is something that we're very, very big on here in our office. So, and again, this works with buyers agents, listing agents, new home agents. Again, we do it all. So, also too, I will just say this: when it comes to selecting a realtor, you very much, when it comes to buying a home, you really want to make sure that you have an agent that's looking out for you and your best interests. Remember, I told you about some of the myths that are out there. So here's one of the myths. I hear a lot of people that say, well, I don't need to work with an agent. I'll work with that listing agent because I'll get a better deal or something like that. Here's the reality. One, you're not necessarily going to get a better deal, number one. But number two, here's the thing. While that real estate agent is supposed to be ethical and represent you and the seller fairly and equally, the reality of the situation is that listing agent has their time and their money wrapped up with that seller and their listing. Whose loyalty do you think that they're going to be more favorable to? Okay. Whereas if you have an agent that's looking out for you, representing you on the buy side of the transaction, we're looking out for your best interest. We're making sure that you're getting a good deal and that, you know, you're not going to run through any of the pitfalls along the way. So, again, we navigate through the financial steps. We make sure that we estimate the cost of the home ownership. Again, we all work as a team when it comes to that. We help you find the right home. We bring up the MLS right in front of you, the multiple listing service, which is the most accurate and up-to-date information. We pull that up in front of you and we will show you what's available. We'll put together a game plan for you to help you find the perfect home. Again, once we do find that home, we'll help you negotiate the deal. We're experts in negotiation. Of course, we'll get you to the closing and, you know, everything that comes along with the closing process. And again, that's all homes, whether it's new construction, if you want a fixer upper, historic homes, single family homes, condos, townhouses. We do it all. We work with you with your needs versus your wants. Okay. Because the reality is, with a lot of buyers, especially first time home buyers, we all want that dream home, whatever that looks like, whether it's the big house with the white picket fence or the condo on the beach, whatever it is. The reality is we can't all afford that. So what can we work with? And then get you in a position to get you that dream home eventually. What can we do to get you started? So again, how much house can you afford? Again, these are all things that we all work together with as a team. We really want to make sure that you're getting into a monthly mortgage payment that you're going to be comfortable paying every single month. So again, negotiating the purchase price. We will help you with estimating the value of the home. Again, everything is negotiable. Sellers versus the buyer's market. Right now, we're in kind of a neutral market. It's really great for everyone right now. We walk through the inspections and the deposits. These are all things that are part of the real estate transaction that we as agents will help you out with. So again, we have counter offers. Again, there's usually a lot of back and forth. You are signing legal documents. These are contracts that you're signing. These are legal documents, and we do help you with those negotiations and advising you along the way. And again, we always try to create a win-win situation for everyone. That's one of our philosophies here at Treasure. Again, these are just some of the things that you need for closing: homeowners insurance, flood insurance, windstorm insurance, mortgage insurance, title insurance. We have vendors and partners that we can help you out with if you need to find these things. And they all really do believe in providing great customer service, just like we do here at Treasure. So again, when it comes to the closing, you have your final walkthrough. So once we get you under contract, right before you go to your closing, we make sure that the home that you're going to be purchasing is the home that you thought you were getting when you went to contract. So we check all the major systems. We make sure that the sellers have all their stuff out of the house and that everything is, you're getting what you thought you were getting when you signed that contract. So, and then again, after we do the final walkthrough, we help you with the closing. When we do the closing, it's an independent, either a title company or an attorney of some kind that handles that for all parties. So it's done fairly, and it's a neutral party that helps with that closing. So, and again, these are just some of the things that we will walk you through. So we help you out to create a budget, include the housing maintenance expense, your reserve fund. We help you live within your budget, your escrow adjustments, your special assessments. Again, these are all things that if you need help with the budgeting, that we will help you out with. So, and again, what are some of the benefits of home ownership? Well, you get the mortgage interest deduction, property taxes. You do get tax deductions on those things. Again, we have the homestead exemption program. What the homestead exemption program is, so first of all, you do get a little deduction off your property taxes when you file for the homestead exemption. The nice thing about the homestead exemption is that when you file, if your property is homesteaded, property taxes can go up as much as 10% every year. But if it's homesteaded, it's capped at 3%. So the most your taxes can go up is 3% every year if it's homesteaded. So again, these are just some of the things that will help you out with. And of course, keep records of all these things, for tax purposes. You know how the IRS and accountants are. So, and again, equity. Like we said, one of the big things about owning a home is you're building equity. I told you about my friend that purchased a home a few years ago for $175,000, sold it for $450,000. One of the things that we had talked about before she decided to sell was pulling equity out to invest in other properties. Again, and we have loan programs that can help with that as well. So, well, what are some of the next steps? We're going to be talking about that here in just a little bit. The next step is, we want to take a look at your credit, make sure that looks good, see what we can do to get you in an optimum position to buy. Look into getting pre-approved. I always tell people before we go house hunting, before we go house shopping, let's figure out what that monthly payment looks like. What does that budget looks like? So that way you're comfortable and you can make an informed decision when the time does come for you to pick out that home. And then again, we'll show you those homes. So this is your slide. So there you go. So now we edited all the slides together. So I would like to introduce to you now Giselle Reyes with Sea Blue Credit Repair. And she's going to talk a little bit about credit and things that you can be doing now to get yourself in a better position to buy. Just push up. Oh, yes. There you go.
We do what?
Oh,
Now?
push the up button and
To the
that'll.
next, okay. So thank you so much, guys. Like Adam said, my name is Giselle Reyes, and I am the owner of Sea Blue Credit Repair, and I'm here to talk to you a little bit about how to get credit ready so that we're able to get approved, so that you can get your home, eventually. And thank you so much for Treasure Property for putting this together, right? Always giving back to the community with some financial education so that our community can be aware of what programs are out there and what can you do to get prepared, okay? So as soon as you decide that you want to, it's not working. Let me see this way. This way, maybe that way. That happened. I know it was work. Oh, there we go. Okay, wait. Okay. Okay. Sorry about that. Okay, now, so as soon as you guys decide, okay, I want to buy your home, right? 3 areas have to come into mind. First is your credit, right? Start saving early, start working on your credit profile as soon as possible. And today I'm going to give you 7 tips, credit tips that you can do on your own to improve your health of your credit health. 2, you want to start exploring, right, and researching mortgage options. Hector's going to be talking to you a little bit today about what your options are and programs available, and ultimately get help from a realtor, right, who can show you homes and assist you with the negotiation process. So it comes hand to hand. So before I go and jump into the 7 tips, I want to start with, sorry about that, guys. Okay, we want to start with understanding how your credit score is calculated, okay? So your FICO score, right, is the score that you typically see and you hear a lot around there. We also hear a lot about Vantage score. When we say, okay, what's your credit score? The first thing I hear is, oh, my Credit Karma says that my score is XYZ, right? 6.0 or 7.0. There's a big difference when you see Credit Karma scoring. And it's not wrong or incorrect or whatnot. It's just a different scoring. And that scoring is called the Vantage score versus the FICO score, which is primarily what the lenders utilize, okay? So the FICO score, we're talking today about FICO 8.8 has 5 areas. One of the biggest areas is payment history, which weighs 35% of that score is in payment history, things that happened in the past. There's nothing else you can do about it because it happened in the past. Either you have to repair it or you have to wait 7 years for the statute of limitation for it to fall off on its own, okay? The other 30% is in credit usage, or what we call utilization rate. This measures the amount that you owe compared to the credit that you have available, okay? And with this scoring model, is very sensitive. When you add balances, your credit score goes down. When you pay your bill, it goes up, right? So every day you kind of see it goes up and down because of the payments you make and then the things that you charge, okay? So it's very important. We'll go into detail on that. And then 15% is going to be on credit history. That means the length of history. What's your oldest account? Have you been doing credit 20 years ago versus someone that just started credit 2 years ago? It makes a big difference, and there's a different impact on your credit score. 10% goes to your type, or what we call credit mix, meaning that do you only have credit cards or do you have a mixture of credits? There's 5 types of credits. So you have installment loan credit, you have your credit card, which is revolving credit. You have your charge card, which is kind of like American Express, where you have to charge, you have to pay the full amount at the end of the day. You have service credit, right? Your Xfinity, Hulu, and all that stuff. Those are service credits. And then the last one that's new one is the buy now, pay later credit. Now it's like Finger Hunt. You see a lot of more online companies coming into that buy now, pay later kind of deal. Those are going into actually the next version of FICO, which brings me to the FICO has a lot. Oh, so my God, a lot of I am so sorry about this. Okay, so So FICO has a lot of different versions of it, and there's one of the newest versions going to include all those other charges that I was mentioning before, the buy now, buy letters and utilities and things like that. I don't know why the next one. I'm missing a slide here. Okay, so the first thing you have to do, guys, is obtain your credit report. Okay, that's number one. Okay, so first thing you have to do is, what is my credit score, to see where you at. One of the ways that you can get your annual report is going to annualcreditreport.com. You can call that 1-800 number, or you can mail it a form and they can mail you your credit report. The only thing is that they don't give you the score. And if you go to other online like Experian, like Equifax, they may charge you a few dollars to get the actual score. There are other credit monitoring accounts. If you're a member from them, they will provide you with your credit score and the credit report. Okay, so it's very important for you to know both things. And talking about the FICO scores, when you look at your, oh my God, when you look at your credit score, doesn't stop. Okay, this is what you're going to see. So on your credit score, you're going to see different FICO scores. Okay, the regular or more widely used is the FICO 8.0. That's the one that you go for credit cards. That's the one they use for a lot of the regular retail stores. And they are very highly sensitive on the utilization. Auto loans they also use different versions. And then the most important one that we're talking today is about the mortgage lending. So the mortgage utilize FICO version 2, 5, and 4. That means Experian, they pull the 2. For Equifax, they pull the 5, and the TransUnion, they're pulling the version 4. Why do they do that? And it's different because the weighing of it is different. So remember that pie that I show you where the weighing is different? It's different for the mortgage. So this version that happened a few years ago, they're less sensitive or less forgiven for collections or paid collections, medical collection, things like that. So that's why you see a difference when you have a FICO 8.0 versus when you pull, the mortgage person pulls your credit, and now you say, well, wait a second, my score is 670, and now you're saying it's 630, because the version that they're using is different. Okay, just for you to understand how that works. Okay. So we want to keep in mind that this is what we want to focus on, which is the payment history, your amount that you owe, and things like that. Okay, and they also provide these type of versions. They also provide like information like employment history, other information that the lenders want to know that the other version may not weigh that on it. Okay, so now that you know your credit score, right, for FICO score, the first thing you have to do now is get your credit. I got it. Okay. So 2, once you get your credit report, you want to check for errors, okay? 80% of credit reports contain errors. 80%, that's 8 out of 10 people here that pull the credit, you're going to have an error. You might have an error in your credit report, and those errors are impacting your credit score negatively and probably preventing you from obtaining a mortgage. Okay, things that you want to look for in your credit report are things that are inaccurate, right? Errors, mistakes, duplicates, they're not mine, identity theft. There's a lot of data breaches out there. If you don't pull your credit, you may never know that those things are on your credit report. Things that are outdated, maybe more than 7 years ago. Okay, I had a client actually that came to me with a 701 credit score, 701, and she wanted credit repaired because she told me, Giselle, I pay all my bills on time. I do not owe anything. And for the life of me, I cannot move from that 701 to a 740, which is right, which would put you in an excellent position for credit. Sure enough, when I pulled her credit and I did an analysis, she had something from Bank of America from 2011 that was still there, and it was a late 60, still lingering, okay? And that was preventing her from jumping from 701 to opening that kind of like that lid, okay? So to explain a little bit how that works, I'm gonna put it right. This is the way the FICO system works, okay? All of us and consumers, we're put in, FICO puts us in a bucket, okay? So we have all the consumers that have, let's say, 2 or 3 collections, they have late pays, and they have a couple of positive accounts here. And this bucket is worth, let's say 610, okay? And just as a disclosure, this is just an example, okay? It doesn't mimic the actual points that FICO gives. It's just to illustrate how this works, okay? Once you remove that derogatory item from your credit, okay, that collections or that late, and in this example, we remove the collections, now you get rebucketed, okay? And now you have an availability to get a 680 score. So that's what was happening to that lady. She maximized her credit score, but she had that one late still lingering there, and it will not allow her to go up to the next level, okay? She will have to wait until more than 7 years, or that was an error because that should have fallen after 10 years, and that was in 2011. So check your reports, okay? And then the same thing here. Once you're here and we remove that late pay that you have, then you get rebucketed again, and now you open up your space to keep on going up for your credit score, okay? So if you see your credit score is not moving and you have no debt, you have paying your everything on time, it could be that you have some derogatory items on there that is putting the brakes on it. So it's not allowing you to move forward with your credit report, okay, with your credit score, okay? So it's very important for you to check for errors and remove those derogatory items that are impacting your credit score or preventing you from moving forward, okay? The second thing you wanted, again, keep going back. Okay, so the third thing, so now we did everything in the past, right? Everything in the past, we check for errors, you print your report. Now we want to make sure that it doesn't happen in the future, okay? So the third thing you want to do is immediately put everything on auto pay, okay? Even if your accounts are zero right now, you have no balances, put your accounts on auto pay. I cannot stress it enough because so many things happen. You go to vacation, you forget something, or there's a minimum charge, an annual fee comes in, you forget to pay that $20, and it's going to cost you 100 points. Just one time that you are late, 30 days, is going to take away 100 points from your credit, from your score. And it's really, really hard to climb back that ladder back up in a short period of time, okay? Because those late pays, the late 30s impact your score for the first 3 years, okay? Anything that's a late 60 days can impact your score for 5 years, and anything that's 90 days or late is gonna impact your score for the full 7 years. So it will never move if you don't remove those latenesses, okay? So that's why it's very important for those latenesses to get removed, okay? A couple of tips that you can do to avoid that: put auto payment, okay? Make sure that your calendar, that when you get paid and your due dates are in alignment, right? If you're not in alignment, you're getting your due date is, before your income, then call the company and change those due dates. It is possible. They'll work with you and they'll change your due date. So you make sure that you get those payments in on time, okay? And then you want to pay your bills at the closing date, okay? Versus the due date, okay? Why? The due date is there so that you do not pay interest rate, okay? So you make some purchases until a certain day, closing date comes, then they give you 15 days for you to pay that bill, right? So the due date is for you to avoid the interest rate, okay? And also, obviously, it impacts your payment due date, right? Payment history. But on the closing date, that date, whatever balance is there is what gets reported to the credit bureaus as your utilization, okay? So if you're making any payments and you want it to count for you for that month, make your payments, I would say, the day before your closing date, okay? So that balance is low. I'd rather you report 50% utilization than 80% utilization, okay? Because if you have a credit card that's $500 and you have a balance of $500 on the closing date, that gets reported, and then you say, oh, I'm going to pay it on the due date, the whole thing, $500. Well, guess what? You have not done anything for your utilization because it's already been reported as 100% utilization. Okay. So now in that fashion, you will have to wait another month for you to see that difference if you don't charge it again. Okay. And it's a cycle. If you keep charging the card 100% and you keep missing that closing date, it's still going to report 100% utilization, and your credit score will not change. Okay. Annual fee dates too. Some of the credit cards have annual fees. They kind of sneak into people. And a lot of folks miss that payment. So make sure you know if you have any annual fees, that you know when it is so that you can pay it. Hopefully you have it on auto pay so that it will pay itself when that time is done, okay? Because different companies are different, okay? All right, so now that we are avoiding in the future, we put everything on auto pay. The fourth thing that you want to do is increase your positive payment history, okay? Because we were talking a lot about the negative, right, payment history, right? So while we're marinating that, right, we're fixing that, we're waiting for the credit bureaus to answer back, we want to put everything we got into payment history, okay? What you can do, report utilities, report your rent, Hulu, Netflix, any streaming that you have, you can go to Experian Boost, Experian.com. It's a free service. It does only impact Experian, but that's okay, because even when your mortgage person is going to pull your credit, they're going to utilize the middle score most likely. So you want to make sure that the higher you got, your average may be a little bit higher, okay? So other ones that you can go into rentreporters.com, they do charge like a fee, like $5 or $6 a month. Simple bills, also same thing, there is a fee for them. However, you see this, they're different credit agencies. So remember, you want to make sure that you're reporting to whichever one you need help with. So if your Equifax is really low, you may want to get the one that's reporting to Equifax, okay? And then you want to add all those positive payment history as possible. So the goal is to have more positive payment history than the negative payment history, okay? Other things that you can do is add yourself as an authorized signer. So someone that is trusted on a positive account, hopefully is an account that has a larger credit limit, and then no latenesses or nothing like that, okay? So it could be somebody that's a family member preferably, because what happens is when you hear people say, oh, just add you as an authorized signer and you can get this credit score, you don't get, the credit score doesn't move to you. What happens is that all the payment history gets transferred to you as if you were doing those payment histories, okay? So for all those years that history is there, guess what? Now you have a whole bunch of payment history on your report, which increases then your credit score. It increases your credit limit, decreases your utilization rate, and your credit score goes up, okay? And then use your cards. If you don't use your cards, they don't get reported to the credit bureaus, okay? So if you have a favorite card, like we all do, right? Rewards, mileage, you know, use the other ones that you don't use, because it costs the bank money to report that. And if you're not using their credit card, guess what? They're not going to report it, or they're going to cancel it for inactivity. And if they close your account for inactivity, then that's really going to tank your credit score, because it affects the length of credit history. It affects the credit limit, which is going to affect the utilization. And it's going to go, your credit score is going to go down big time. Okay. So you don't want to close any accounts as well. Okay. So use your cards. If you have one that you don't really use, take them out of the drawer and use it for coffee or gas card and pay it. Okay. And you do that. Okay. All right. So number 5, now that you got that done, you put all your payment history, right? Because now you're adding to your credit report. You want to start paying down your revolving credit card down to 30%. Okay. The rule of thumb is below 30%. Okay. But if you really want to maximize your score, FICO rewards consumers if you keep them between 1 and 7%. Okay. So remember, I said 1, not 0. So for those that like to pay the whole thing at the end, it's better for you to leave 1% or at least $2 in there, or some balances. Okay. Why? Because remember, the credit bureau is all about data. So they get all this data, right? If they see that you're not utilizing a 0, you're reporting 0 every month, then it's going to assume that you're not utilizing it. Okay. So make sure that when you're paying it, that you're paying it before the closing date, obviously, so it could get reported, and leave some type of balance in there. Okay. Create a spending plan first, which is the first thing you have to do, right? You have to print your statements, your bank statement, go through it, see what's on there that you can kind of carve out. You know, you'll be surprised how much people I've seen when I do this with my clients, that they have, or they spend like $300 in Starbucks coffee, okay? And they didn't notice because everything is $5, it's only $2, $8. But when you add them all up at the end of the month, it was like $300. Okay, so now it's time to come here to Treasure and get free coffee here in the lobby, okay? So you could save that money and put it towards your credit cards, all right? So visit us all the time. Then once you know where your money is going, you should be able to know right now every dollar where it goes. Even if that dollar goes to your savings account, at the end, you should have zero when you're balancing your books. Every dollar has to have a home, every dollar, okay? Whether it's to pay a bill, whether it's to pay a credit card or to savings, okay? But it has to have a home, every single dollar. Once you know where it's going, now you create a budget, right? Okay, well, now I'm gonna know what I'm going to be utilizing my money. And then gain financial education, what you're doing right now, visit some seminars, workshops, and get the education you need. And then don't close, we already talked about that, do not close any accounts. So when you pay them down, do not close any accounts, please, because that's going to hurt you, okay? Leave them open and utilize them, okay? So a couple of things that you can do, right? So you say to yourself, well, how am I going to pay all that bill if I don't have any money? Well, there's two debt repayment strategies, okay? One of the strategies is what we call the snowball effect, okay? Snowball effect is the strategy where you list all your credit cards and you want to pay the smallest balance first. You get rid of that first, you put it all as money you can, and then everybody else gets minimum balance, okay? Doesn't matter, just minimum balance, and you put whatever you can that month into that credit card until you pay it off. And then you go to the next one. And then you put every money you want in that one, and everybody else gets minimum balance, okay? If you want to do the avalanche strategy, that's where you focus on the credit card with the highest interest rate first, okay? And if you have money, you can do that, and then you work yourself down on the other ones, okay? There's no best or not, it's just depending on what your financial situation that you're able to pay these debts down, okay? So don't get nervous, don't get overwhelmed. We all get overwhelmed. Sometimes we don't know where to start. This is a great place to start. Put them in a list and you go through them, okay? How much money, what's your minimum balance? And then start paying them one at a time. It's kind of like, how do you eat an elephant? One bite at a time, right? And those are two strategies you can use, okay? So next thing we have, now that you're paying your cards down, let me see where we go. On 6, okay, you want to avoid applying for new credit, okay? The biggest mistake we see all the time, and because that is that when you want to buy a house, you can't go out buying a car in that same year or buy, larger items, Home Depot, we see it all the time, because the more debt you're putting in, then it affects your debt to income, which is going to prevent you from getting approved for your mortgage, okay? So whenever you see Macy's, JCPenney, and you go and they offer you that 20% off, right? Don't do it, because that 20% off can cost you more money than that, okay? Say no unnecessary credit for you to be adding to it. Why? Because new credit can really lower your credit score, okay? It affects your inquiry, because it's going to be a one hard inquiry. It's going to affect your length of history, because now if you have credit for 20 years and now you just open this account, well, guess what? You just shrunk your length of history, because they take the average of it. That's why it's a big hit, okay? So you don't want to open this new one if you really don't need it, okay? You want that length of history, okay? If you use the new credit, it's going to increase the amount you use, right? So it's more debt and affect your debt to income. And if you don't use it, then it affects your utilization too, because they could close your account. So be careful. This is like a vicious cycle. So it's kind of like playing chess. If you move one, the other one affects it. So you got to be very careful and strategic, okay? So when you open accounts, you want to make sure that you know, why are you opening that credit card? Are you opening the credit card because you have this high interest balance here and this guy have a 0% balance transfer? Then yeah, it'll probably be better for you, because now it's going to help you minimize your debt. I would say go for it. Or if you're opening the account because you need credit, if you're building credit and you're opening an account and that bank, it's not reporting to all 3 credit bureaus, you're not doing anything for you. So you have to make sure that if you're building credit and you're opening this account because you want to build credit, you have to ask that company, which credit agency do you report to? Some of them just report to one, some of them report to two. You want to report to all three of them because you want to build credit on all three of them. Okay. I think, okay, so I think I covered everything here. All right. So good. Then the last thing we want to do, so after we do that, number 7, we want to maintain a variety of credit accounts. Okay. So if you have only credit cards right now and you have no installment loans, that could be impacting your credit score as well. Okay. To maximize your credit score, FICO likes to see at least 3 to 4 active revolving accounts. So it has to be active, not closed. It has to be active account that you're making payments on a monthly basis. And they would like to see 1 active installment loan. Okay. It could be a personal loan, auto loan, anything that is classified as an installment loan, and obviously a mortgage. The mortgage will definitely also boost up your credit score. Well, after the fact, not the best. As soon as you get the mortgage, it'll go down, but then it'll go back up big time. So it'll go down temporarily when you open your house, but you'll have your house by then. So this is kind of like the mix that they like to see in order for you to maximize your credit score. Okay. Now that doesn't mean that you're gonna go out there, run out there, and open up 4 credit cards or open up a installment loan, but that's just for you to know what you need to do to get it. Okay. And if you decide to open up credit, you have to also space them out. Okay. You don't want to open up a credit, like say somebody's building credit and then you want to go and you want to open up 3 credit cards at the same time. It actually hurts you than it helps you. So you open up an account, make at least 3 or 4 payments, and then you open the second account. Okay. There's nothing that FICO or any law says how many is too many. Because it's really not the quantity of credit, is the behavior, right? The quality, how you behaving on that, okay? So you wanna open up maybe every like 6 months, then you could open up another credit card, space them out, and then you open up another credit card if needed, as you need it, okay? And then, so that will be your last step. And then that will be it. Then Hector will tell you about how to get your mortgage and some mortgage options. Okay. And then what kind of, did you have a question? I know you kind of like, no? Okay. No, I thought you went like that. So, okay. Because we're going to collect questions after the presentation. Yeah. Okay. So I'm going to have, I know, I think it's down. Let me see. I kept on saying up. Let me see. It's up. It's up. It looks like it's up. Sorry. No, just I think it's not. Let me see.
See, it's not working.
It gets snippy.
There we go.
Well, thank you, everyone. It's sorry about the technology.
So good evening, everyone. Thank you for coming and joining us today. I think these home seminars are very important. There's a lot of misconception in our community in the home buying process. I hear it all the time. People think that you need this huge amount of money to buy, huge down payments, excellent credit score, and that's not the case. We're going to go over the whole process, what it takes to buy a house, and help everyone here, whether it's your family members or yourselves, achieve that home ownership dream. One of the most important steps in the home buying process is your pre-approval. Pre-approval is important because if you start to go look for a house, first thing a real estate agent is going to ask you for is, do you have your pre-approval done, right? And you need to have that because if you start seeing properties, you see a house you like, and you want to put an offer, well, you're already behind the 8 ball. You don't have your loan ready. Somebody else is going to come that's already pre-approved and beat you to that property. So it's always the first step, the most important step. So in the pre-approval process, the most important step is going to be your documentation, right? Having the correct documentation ready to provide to the mortgage loan originator. The documents is what's going to give us your whole financial picture, right? So I put a list together of the documents we need for W-2 employees. W-2 employees are those that are on a W-2 income where your taxes are being deducted, whether you work for a company. So we're going to need 2 years of W-2s, the 2 most recent. So in this income tax season that we're in, that would be your 2022s and 21s, right? We would need pay stubs from work. We need pay stubs to cover a whole month. So if you're getting paid weekly, we'll need 4 pay stubs. If you get paid bi-weekly or semi-monthly, we'll need 2 pay stubs, right? We're gonna need also a copy of your driver's license. And then we're gonna need the 2 months bank statements where you have money that you're gonna use for your purchase. So that's very important. For W-2 employees, and something I want to touch on, when you're buying a house, it's very important that you have job consistency, right? Because I see a lot of scenarios where people are working one job 3 months, they jump to another one 2 months, and then before you know it, they have an application with 7, 8 jobs. And that doesn't look good, because when an underwriter is looking at that file, they're not looking at that consistency, and it creates problems. So I always recommend try to have consistency in your jobs. I understand if somebody's gonna get a better job because they're making more money, understandable. You know, we don't look at that in a negative way, but we do want to see consistency with the jobs, and we need a full 2-year history. It doesn't have to be consecutive, right? But in total, 2 years, okay? Self-employed borrowers. Self-employed borrowers is a little different because the qualification is going to be based on their income tax returns and how they're filing their returns. So if the person is like a 1099 contractor, right, we're going to need the 2 most recent income taxes, right? So in this tax season, it would be 21 and 22. It's very, very important that we get all the pages to the income taxes, because there's different schedules and things we need to see on there to be able to calculate your income properly. Very important. If they file business tax returns, we're also going to need the business returns, because the business returns have the business income that then flows into the personal. So we have to see how that income is broken up so we can do our calculations correctly. With self-employed, one of the biggest things that I encounter during the pre-approval process is the gross income that comes in, and then the deductions that the people make, and the net income. When we're qualifying for self-employed, we're going to qualify with the net income that they're after your deductions. So one of the things we encounter a lot is, you know, and you see this all the time, where CPAs will do people's taxes to save them money. They start deducting all the business expenses. So they're making an X amount, but then when you look at the net income, they've deducted practically everything, right? And that hurts you for your pre-approval, because then you don't have income to qualify. And we have to qualify based off that net income. So that's one of the most important things to prepare. When you're going to buy a home, you got to let your CPA know that, right? You got to let your CPA know that you're going to be buying a house, because they know that now they got to be careful with the deductions. Because yeah, doing a lot of deductions saves you money with the IRS, but it's going to hurt you when you're going to buy a house. So that's a very important detail. And then the same, it's going to be your copy of your driver's license, 2 most recent monthly bank statements showing any funds we're going to use for purchasing. Okay. Non-resident alien borrowers. Okay. So there's another misconception that people think that to be able to buy, you have to be a US citizen or a permanent resident. But actually, if you have your employment authorization card, and you have your tax ID number already issued, and you've established credit with that tax ID number, you can qualify like a US citizen, right? And it's going to be the same documentation, same process. For W-2s, the W-2 paperwork, or if they're self-employed, the self-employment. But they can buy. Now, that work employment authorization permit has to be current, right? If it has expired, immigration right now, the delays are very long. If it expired and it hasn't lapsed 6 months, they're still good as long as they've submitted their application for renewal, because that gives them an extension automatically for 6 months. So that part's very important. And of course, permanent resident aliens, you just need a copy of their current resident card, that it's current. But the same process as well. Okay, so I'm going to touch on, I know Giselle covered the credit, very extensive. One of the most important steps in the pre-approval process is pulling your credit report. And when in the mortgage industry, we pull what's called a tri-merger report. So it's going to be all 3 of the credit bureaus, right? That's going to show us all your trade lines. It's going to show us your scores for all 3 bureaus. We qualify based off the middle score. So not the highest bureau, not the lowest, the one that's right in the middle. And that could vary depending on what your scores are. So for example, in this scenario, if your Equifax is 720, your Experience 712 and your TransUnion 725, we're gonna use the middle score 720 to qualify. Okay, so that's very, very important. A scenario I run into a lot is people that don't have any credit scores, right? Because they have brand new credit. I'll pull their credit report and all three bureaus have no hit. So when I get customers like that, I always give them some instructions, right? One of the fastest ways to open, credit, to get that credit established, is opening up what's called secured credit cards, right? So these are credit cards that several banks offer, where you're going to deposit money into a bank account. Usually it's a savings account, right? And they're going to give you a credit card with that same limit. And that credit card functions like a normal credit card. I've had customers that have opened those cards, and within 2 months, they already have credit scores reporting on the bureaus. As long as we have one bureau reporting, we can use that to get the mortgage process going. Okay, so that's very important. Okay, derogatory trade lines. And to interject on some of the things that Giselle said, late payments is something that you got to avoid at all costs. Like 30-day late, 60-day late, 90-day late, they're terrible for the credit. I mean, they'll drop your score 100 points. I've seen instances even more. So it's very important to avoid that at all costs. Collection accounts. Collection accounts is another detail that's important on these credit reports. A lot of times I'll pull a credit report where there's 3 or 4 collections. The best way to take care of those collections, if they're small ones, is paying those creditors off and asking for a deletion letter, right? That deletion letter allows me to be able to submit it to the credit bureaus and erase that negative history, right? And bring up your score again. And that's important. However, if we have collections where now they're very big and it's very complex, that's where I'm going to get Giselle involved, right? And we're definitely going to look at one of her credit repair plans. But if it's little small collections, like a little $200 collection here, a little small one, I've seen collections for $50. I mean, phone bills or Comcast or AT&T, those places are notorious for charging you collections because it's always the same thing, the equipment. You never return the equipment. And those little things like that we can fix. Those are easy fixes. We can actually just get the deletion letters and I can help you rescore it. Anything that's very complex, where it's a lot of large, I've seen large car repossessions, right? And they're actually in a collection status with large that's the stuff where we definitely need help. Giselle's expertise in that to get that done. The balances on the credit cards, the utilization. The utilization is also a thing that I see a lot. And what Giselle said is very important about the closing date. If the card reports the high balance, that's what's going to show on the credit report, and that's what's going to drop your score. So it's always important to find that closing date, right? But that's always an easy fix, because if I pull a report that has high utilization, we can go over that and say, okay, if you pay this card, right? You get me a new balance, a letter, I can do a rescore. I have the capability of submitting that to the bureaus, and in less than a week, be able to shoot your score back up and not have to wait for the credit cards to report it. Because usually these credit cards take like a month to report. So I can do that within a week. If it's a few cards, we're talking about it's a long, then it's going to be a longer process. Okay, debt to income ratios. This is what we use to qualify. This is what's going to determine what is the purchase price that somebody qualifies for, right? So what we look at is, we're going to look at your monthly debt payments divided by your gross monthly income, right? And this is the number one way that we use to manage, to see what you're able to repay, right? And this is what's going to determine your qualification. So for example, once I complete a pre-approval, I run those numbers. Normally, you have to be at about a 45% debt to income, right? For some of the loan programs. Others, we can go really high. Like FHA, we could go up to 56%. But the lower your debt income is, the better it's going to be for you. So to touch on another subject, don't open up new credits when you're going to buy a house. If you know you're planning to buy a house, avoid getting a car loan, avoid doing high purchases, because all those things are going to affect this number. Okay. Assets is a very, very important component of the pre-approval process. So during this process, we're going to need at least 2 months bank statements to see where the money is coming from that you're going to be using for the purchase, right? We want to see that those funds are there in the account for at least 2 months. One of the things we look for is the deposits that you're making in these accounts. So You always want to avoid making large cash deposits into your bank account, right? I see a lot of folks that'll, I don't know why, they cash their checks and then they keep cash at home and then they let the cash accumulate and then they want to deposit it later in their accounts. That's a big no-no. Because then when you reintroduce that cash into the accounts and we submit those bank statements to the underwriters, they're going to question that. So now we got to show proof where that money came from. And it's a very hard battle. Like a lot of times they don't let us use the money. So then it creates a problem because now we're short cash to close. So just avoid cash deposits as much as you can. And I'm not saying little small transactions. Talk about large, you know, I've seen folks depositing 10 grand, 16 grand. Like those are things that affect you, right? Not to mention with your bank account, you deposit anything 10,000 or more and you get flagged by the, you know, the bank will report you for a high currency transaction to the IRS. You can do a gift, but there's a way to process that gift, right? So there's a way to do it where we have to do a gift form, right? And then we're gonna do a transfer directly from your account to either the title company handling the closing or to his bank account, right? And there's a way, we gotta track it, there has to be paperwork. You could do a wire transfer or you could do a check from your account. We just have to show the paper trail. It can't just be you give him cash, he deposits it, because that's a problem. No. Definitely wanna hold off on doing that. Very important. Investment accounts, if you have stock market, mutual funds, things like that, those are things that you can actually liquidate and you can use for that, right? We could use investment accounts, retirement accounts, 401ks. You can use that to purchase your home. A lot of times you have to check with your provider at work to see what are your withdrawal terms. There's a lot of different, depending on the provider. Sometimes they'll do a loan against your own funds. Sometimes they'll let you buy it, take it out if you're a first-time home buyer. There's exceptions. So you always got to check with your provider. You know, worst case scenario, you could always close it down, but then you're going to have the IRS penalties and they're going to take out the withholdings, right? But you could use your retirement accounts. Gift funds, what we just spoke about. Yes, you can use gift funds, but gift funds have to come from a family member, right? It has to be a relative, you know, your mom, dad, brother, sister, uncle, cousins, right? Where it gets tricky is if it's somebody that's a friend, right? A lot of times we have that best friend or that family member, that family friend that's like a family member, but technically they're not. So that could create a problem with the gift. So we got to be careful with that. You could also get gifts from your employers too. Like if you work for a company, your boss wants to help you buy your house, they qualify as a donor as well. Okay. Okay, so the down payment requirements, and this here, this is a subject that has a lot of misconception. I don't know why people think that you got to have 20% down to buy a house, which is not the case. If this is a primary residence where you're going to live there as your primary home, you know, you can buy with as little as FHA has a 3.5% down payment. Conventional has a 3% down. And our VA loans for our veterans and our military service members, you don't even need a down payment to buy, right? The program that we choose is going to depend on your individual credit score, right? Your debt to income ratios, right? And, you know, your assets, how much we're putting down, all that's going to determine what program we go with. They both have their pros and cons, but they're excellent programs. The FHA is the program that's insured by the Federal Housing Administration. So it's a government backed loan. FHA has the convenience that it has lower interest rates than conventional, right? But you have mortgage insurance with this. Mortgage insurance, you're going to have it for the life of the loan. Mortgage insurance, I know you guys have heard that term PMI. Some of you have, right? That's an insurance that covers the bank in case the owner defaults on the loan and the house goes to foreclosure and there's cost involved. Well, that covers the bank. But that insurance really doesn't do anything for the home buyer. You know, that's an unnecessary expense that is always a good idea in the future to remove that, to get rid of that, because that's, you know, it's going to lower your monthly payment. So that's always something to keep in mind. Conventional loans are going to be more for, oh no, I'm sorry. With FHA is more lenient on credit scores. So with FHA, we can go as low as a 580 credit score, right? Ideally, we want to try to be higher than that because the higher, of course, the higher your credit score, the better your interest rates are going to be. Okay. But it does give you the flexibility that you could go as low as a 580. Conventional financing is more for individuals that have like a 680 credit score or higher, right? It's a little bit more strict with your debt to income ratios, and it allows a 3% down. So conventional is a great option as well. But again, it's going to depend on, you know, the individual scenario for the person. Let's see. Okay. And then I don't have the VA on here, but we do have the VA loans, which are for the veterans. These are the people that are retired from the military or active military members. So those type of loans don't have a down payment requirement and they don't have PMI. They're, excuse me, they're excellent loans because you can, as a military member, you can do that. And also if that military member passes away, their surviving spouse could take advantage of those benefits. Okay, so the Hometown Heroes. Hometown Heroes was introduced last year in June, right? But it was only introduced, it was being offered to only certain professions. So it was mostly for the police officers, the teachers, the nurses, doctors, people in the healthcare industry. And it was a phenomenal program. You know, they started with 100 million. The program just actually ran out of funds the beginning of this month, right? So now they announced, the Florida Housing Org announced that they're going to reopen the program now in July. They've allocated another 100 million to the program, but now they're opening it to all Florida residents. So there isn't any requirement with the careers, with the jobs, right? It's going to be open for everyone. One of the requirements for the program is you have to be a first-time home buyer. So in the mortgage terminology, first-time home buyer is somebody that hasn't owned a home in 3 years. So if it's been already a lapse of 3 years, you're considered a first-time home buyer again. Okay. You have to be a full-time worker with this program. So if you're a W-2 employee, it is very important that you're working at least a minimum of 35 hours a week, right? There's a lot of jobs in the healthcare industry, you know, doctors' offices where some reason they don't allow them to work the 40 hours. Some of these offices will work 32 hours, 33 hours. If they don't work 35, they will not qualify for the program. No, this is for W-2 employers. Yeah, W-2 employees. No, self-employers could do the program, but this requirement of the 35 hours. Yeah, the 35 hours is for W-2 employees.
But for self-employed buyers, they have to be a business located in the state of Florida.
Yes, that's the other requirement. If it's somebody that's and also for W-2. So for W-2, if their business, if you're working for a company, right, and their main offices, corporate offices are out of state, they have to have a physical office location in Florida that you're working at. So this will affect people that work remotely and work for a company that's out of state. They will not be able to do the program. But if they have an office, federal government, yes, if you have a location where you report to here in Florida, they have to have a physical office that you report to, you know, that you're stationed out of, in other words. Even if you work remotely, but you got to be stationed out of an office that's located in the state of Florida to be able to qualify. Very important. You got the 35-hour rule, very important. This program doesn't allow non-occupant co-borrowers, right? So non-occupant co-borrower is somebody that, for example, wants to co-sign for a family member, right? To help them qualify, but they're not going to live at the property. They're not going to occupy the property. Program doesn't, you can't do that with this program. I'm sorry? If you live with the person, that's different. Yeah, if you live with them and you're going to live and reside at the property with them and you're co-signing, yes, absolutely, you qualify for the program. Yeah, and if the primary person on the loan is a first-time home buyer, you qualify. Yeah, for the program.
So the co-signer doesn't need to be a person.
No, if they're occupying, no, as long as the primary person. Yeah. Okay, very, very important on that. The way the program works is they're going to give you a 5% of the loan amount. So after you do your down payment, let's say we do the conventional 3% down. That amount that you're financing, they'll give you 5% of that loan amount as your down payment assistance. Okay. The assistance, the way it works is they put that as a second lien on your home, where it's a 0% interest loan that you pay in the future, right? So how do you pay it? When you pay your mortgage off and, you know, down the road, they'll come and collect, you know, you have to pay that off. If you refinance the home, you'll have to pay that off. Or if you don't occupy the home anymore and you decide to turn it into a rental, they can come and collect the funds. Okay. But it's a zero, it's a deferred loan, so it's 0% interest. So it's something that for an individual that doesn't have the funds to acquire property, it's an excellent program, because you don't have to pay that money right away. You can pay it in the future whenever you want. And even if you sell that house down the road, remember, you've accumulated a lot of equity in the property. So it's a win-win, because you're going to have more than enough to pay off the loan and you're still going to get proceeds. You understand? So it's a great program.
Starting July 1, is what
No, so we can start now, right? So we can do the pre-approval. You can start taking advantage of it, but we have to close after July, which we're already practically there. As long as we reserve the funds after July. So the way it works, once we do the pre-approval, right? You start your loan process, you're shopping for the home, right? Once we complete this pre-approval process, then that's when I tell the realtor, okay, you qualify for this price range, your maximum monthly payment will be X amount. Based off that, they'll do a search on the MLS, they'll see properties in that range, and you start to look for your house. The moment you see a house that you like, or you're ready to put an offer, you tell your realtor, okay, I like this house, let's put an offer. They'll do their job, check their comps, check okay, looks good, they submit the offer. The moment that the sellers agree, okay, we like the offer, we accept, and they sign that contract, that's it, the contract's executed, we're under contract. That's when the official loan process starts. Because that's when I get the contract, I complete the application, and I submit the file now to opening. That's when you get your loan estimate, your disclosures, we do the initial step. From start to finish, once you're under contract, it's going to take us about 30 days. Usually I'm closing deals between 20 to 30 days. So it's a pretty quick process. So, and that's something that you coordinate with your agent and with your lender. If that's a good time frame for you, if you need it a little longer because you're trying to coordinate moving, we can work with that. That's not an issue. I like to, in the beginning of the pre-approval process, really dig deep into the file and try to anticipate any problems we could have. If we have any credit issues, fix them. Because why? Because once we're on the contract, I want it to be cruise control, smooth process where we're going to get to the finish line. Because the goal is to get to the closing table, right? So we're going to tackle any issue we can have up front, so that you can be rest assured that once we're on the contract, this is not a deal that's going to fall apart, that we didn't do our due diligence in the beginning, right? And then the documentation also that they're going to ask for during the loan process is going to be pretty easy. It's just your normal verifications from work, your IRS transcripts, the title work from the title company, and just all that. We check that, we verify that, and then the underwriter, which is the person that officially gives the approval and says, okay, we're good to close, that everything is smooth, that we have a smooth approval. That is the main goal, okay? And pretty much, the pre-approval, finding the house, the initial disclosures, the processing part, by processors, I have a team of processors that they're going to look at the paperwork, make sure everything's in order. If there's something missing, they'll reach out to you and they'll work with you. We have a team, that our goal is to get to the finish line. Yes.
Say that they pay up to 5%.
5% of the, yes. Yeah, so the loan amount. Yeah. Yeah.
Or 300. Then I'm going to do a 5% down.
Yeah. So, yep.
When do I know what amount I'm getting as a loan?
Oh, I'll tell you right at the moment we do the pre-approval, or when you get that contract on that particular house. So a scenario of 300,000, right? And let's do it easy. Let's say you're doing the 3% down conventional, right? So you're financing 3% down. You're going to be financing 309,278. That's going to be your loan amount, right? Out of that figures, they'll give you 5%. So 5% of that, you're going to get $15,463 as your down payment assistance. That's going to cover a lot of your closing costs, a big portion of it. Is it going to cover everything? No. You definitely have to have at least enough to put your initial deposit. I would recommend at least try to have at least 5,000 if you can put away, because most of the deposits, most of the escrows are going to be about that range, about 5,000, right? And then the rest we can cover it with that. If we're even short, we can negotiate, try to get the sellers to help us somehow. There's always things we can do. Understand? We can it's just putting a strategy together to get to that finish line. But yeah, it's 5% of the loan amount. The great thing about the program too is if we have money that's over, right? Because I've had these cases where we had more money They don't give you cash back, but they do allow us to reduce your principal loan amount, which is phenomenal. We don't lose that money. So that's great.
Plus, I was gonna say, plus too, after you buy the home, you typically would have other expenses like moving expenses, and you're gonna wanna buy things for the home. So if you can get that money up front to help the down payment, you're gonna have costs after closing. So whatever money you get up front, it's helpful.
Yeah, absolutely. Something very important I want to cover. No, I'm just going backwards. Hold on. Okay, so during your loan process, right, there's a lot of things that I recommend that you be careful with. Number one, while you're in the middle of your mortgage, you do not want to go shopping and opening up new credit cards, like Giselle said, getting yourself in debt, getting a new car loan, co-signing for a family member. If somebody comes and says, hey, can you please help me? I need to get, no. Because all these things are debt that are going to show up on your credit report. And what happens is during the loan process, a few days before closing, my underwriters will do what's called like a credit refresh, right? And if any new debt came out, even inquiries will show up there. Anything that comes out is going to affect us on our debt to income ratio. I can't stress this enough. I've had situations where people were a week away from closing and they decided to go to Ashley Furniture and rack up $10,000 in brand new furniture. Well, guess what? Now you have furniture and you don't have a house to put the furniture in. It's a big problem. So you have to be very careful with that. Very, very careful. Yeah. Oh, her wedding ring. Yeah, we had one of those too. And bought his fiance a wedding ring. Well, guess what? You got to go back and return the wedding ring because. So I can't stress enough. Try to avoid it's common sense, but just avoid a lot of this stuff. Whenever in doubt, always reach out to your loan officer. Any questions? There isn't any stupid questions. Whatever you need, always reach out to us whenever in doubt. But if you follow this, I mean, I guarantee you there's no reason why, you can buy your home. One of our main goals here is to promote home ownership. That's why we're so passionate about this. We go to the seminars, we try to help our community members because this is an investment. This is an awesome investment. Like renting is great when you have to do it because you have no option, but that rent money is paying off somebody else's mortgage. No, you want to pay your mortgage because that's equity accumulating, and it's a win-win. It's always a win-win. Like right now, you're going to hear in the news and the media, oh, the rates are too high. The market is the market. The market is not going to change, right? But you got to pick your poison because if you wait till rates go down, well, guess what? Now the property prices went up 50 grand, 100 grand. So what's worse, paying an extra 150 a month, or now you got to pay 100,000 more for that house? You could always refinance down the road. So don't let that deter you. Okay. So, and that's pretty much it. I mean, it's a simple process. We want to open up to some questions, Adam.
Yeah,
Yeah, somebody.
Open up for a quick question. I will just say this, probably the biggest piece of advice. You have the microphone, so I can-
Oh yeah.
Just everyone online can hear me. So first of all, for those of you that are online for this Q&A session, feel free to write your questions in the comment section, in the chat section. We'll answer those questions. And please look at the chat if you can. The best advice that I can give, probably the question I get asked the most is what should I be doing? And the best advice I give is just start planning now. While buying a home is a very easy process, it can take a little bit of time. Because just say, for example, you have perfect credit and you don't need any help from Giselle, okay? And you get with Hector and Hector gets you pre-approved right away. There's no issues there. And you come and you're ready to work with one of our agents to start buying a home. Well, it can take anywhere from 30 to 60 days, maybe even longer until we find you that home. And then it's another 30, 60 days once we get you under contract to close. So it can very easily be a 3 to 6 month process. And that's if you're in a great position and you don't need a lot of help there. So something that, start planning now, even if you've just recently renewed your lease and, you still have 11 months until time is to start buying, start doing it now, start planning and working on it now. So.
Especially if you have a lease that's it's going to be expiring, somebody's renting, don't wait till you have a month left on your lease. Because now we're all scrambling last minute to run around like maniacs.
Yeah.
You do not want to be in that stressful position. So exactly. I recommend that.
And then you rush into purchasing a home that you end up not liking.
Right.
Because as the agent, on my end, that's what happens.
And-
You rush it. Don't know.
And don't get me wrong, I've worked with buyers, we found something, got it closed in under 2 weeks. It's possible. We've done it before. We're great like that.
That's stressful.
But, right, exactly. It could be a process. It is a stressful process. But we do everything we can on our end to minimize that stress as much as we can. So, were there any questions for any of us or for anything that you saw?
My friend online.
Yes.
she wanted to know more about the VA.
Okay. About VA, yeah.
Yeah.
That was the question I was
So yeah, the VA program is phenomenal. And when you combine it with the Hometown Heroes, it is great. I mean, we had one customer that we did
You end up with money, extra money.
extra money that we brought down as principal
Wow.
because there was an overage. Because VA doesn't require a down payment. The only thing you're required to cover is your closing costs. But if they're giving us a 5% of the loan amount, that's more than enough to cover your closing costs. So you're gonna have an overage. So that overage, we'll use it to bring down the principal loan amount that we're financing. So if we have a $5,000 over, guess what? We lowered the loan amount. We're financing $5,000. Just to give you an example.
And you
Yeah.
also use it to find out what's on the interest.
No, there's no points with this program, which is phenomenal with the Hometown Heroes. No points whatsoever. And no, there's no way to reduce. They give you a fixed rate and they publish that rate every day. But the program has a rate that's below the market. So their rates right now for the program are lower than the normal conventional FHA rates that lenders have. It's a great program all around. They're not charging any origination fees. Origination fees are what's called points. There's no origination fees with the program. So yeah, if your friend's a VA, tell her to take advantage of that. Yeah, for the VA, very important. She's gonna need her DD 214, right, which is her separation, if she's active or separated from service, the DD 214, and her certificate of eligibility from the VA. She can request that from them. I can even help her. If she doesn't know how to do it, we can request it. It's gonna take a few days to get it, but we can do that. Okay?
Yeah, the questions online?
Yeah, this is a little way.
Yeah.
Self-employed qualify for the Hometown Heroes program for everyone?
Oh, yeah, self-employed can definitely qualify for the Hometown Heroes program. Absolutely. It's the normal qualification. We have to look at the 2-year tax returns. We can get away with 1-year tax returns on approvals if the person has been in business for more than 5 years, right? And if their credit score is like at a 720 or higher, a lot of times we get an approval with 1-year taxes. But yeah, normally it's going to be 2 years of income taxes.
For the Hometown Heroes program, they have self-employed for business in the state of Florida.
Yes, the business has to be in the state of Florida. It's the only requirement.
Were there any other questions online? Okay. Nice. Any other questions over here? No.
When it comes to credit repair, what can be repaired and what can be repaired? From the items that you have in your credit.
Anything that's invalid, incorrect, there's duplicate, anything that's outdated, it's game on, because the FCRA, it's the law that protects us and says that your credit report has to be 100% accurate. So if there's anything where there's repossessions, collections, latenesses that are incorrect, incomplete, anything like that describe those there, you have the right to have them removed. And if those furnishers or the credit bureau cannot verify or validate it, they have to remove it. So yes, it is possible. Some of them are more challenging, too, because it takes more time and more letters to be sent, but it's not impossible. Yeah, because we have removed bankruptcy, we have removed repossession, we have removed things like that. But just know that even if we are able to get the removal of collections or any derogatory items, that doesn't mean that you don't owe that collections. Because remember, what you're disputing is the reporting of it, that it shouldn't be on your credit report. Okay, we're not disputing that you owe it or that you may still very well owe the debt. Okay. But our job is to remove it because there's errors or incorrect information in that. Now, talking about bankruptcies, even if we're able to take the bankruptcy off your credit report, just know that the lenders will they utilize other software that they might be able to view that there has been bankruptcy in the past. So just keep that in mind as well. So the only thing good about it that when you remove it from your credit report, then it opens you up for other things. I have a client that had one and we were able to take it out from, let's say, from TransUnion, but Experian is giving us a hard time to take that bankruptcy out, although we have the right to do it because it was incorrect and it should not be there. But when he goes out and tries to apply for a credit, he has a 680 score, he keeps getting declined because that bankruptcy keeps on showing up in his credit report. Okay, so even if we are able to remove it, the lenders still have other software that you guys look
Yes.
at. Yeah.
You see. But with the bankruptcies, if you've had 2 years pass as from your discharge date, we can approve you for a loan with FHA without a problem. Right, so if you've discharged it, chapter 7 bankruptcy is the most common one we see. If 2 years have lapsed from the discharge date, you're good to go on the waiting period. So that's one of the convenience things with FHA. Yeah, we have to look at that discharge date. We look at the bankruptcy documents. We see when it was discharged. 2 years, once we hit that 2-year mark, we're good to go. So even if it's still showing on the credit report, as long as that time lapse, we're good.
Was there another question online?
Well, can you touch real quick on something?
Okay.
Those debt consolidation companies, because I'm
Yes.
seeing that more
I
and more.
know.
It's driving me crazy. Really, it's-
Yes, for the debt relief programs that you probably see a lot and that you probably get a lot of mail, right? Consolidate debt, that is not a good thing. And it's actually doesn't go away. So even if you're able to, with these debt consolidation, but this is the process, right? When you call them, they're gonna probably ask you for you to stop paying your bills for 4 months, okay? When you stop paying your bills for 4 months, your credit score is going to tank. It has to be that way because you have to be in default in order for them to make a negotiation and settle. Okay, so you're going to have to be okay with your credit score tanking for that amount. And then they're going to probably charge you 20%, to represent you as a lawyer. Okay, so, and then to make the negotiation. So even if they're telling you, okay, well, we can settle 50% of your debt. Well, guess what? That's 50% that you're saving. You're gonna have to pay that lawyer to represent you, make those settlements. So are you really saving? Depends on the balances, right? And it takes about 3 to 4 years for you to finish paying that debt settlement company. While you are in debt settlement, you cannot dispute those items. So credit repair has to happen after you finish the debt consolidation loan. So now you're locked in for 4 years until you pay those debts down. So it's like a vicious cycle. So be careful with those. I see a lot of those debt relief programs for minimum amount. If you owe, I would say even less than 20,000, you really do not need debt relief. You just need a budget and money management skills, because you really can't. Because that will, if you put yourself in a budget, you could probably pay it off in a year or two, versus getting through this. And even if they pay all these items, guess what? It stays on your credit report and it's going to say paid for less than amount owed. It doesn't remove it from your credit report. Okay, so it's really like a 50-50. Okay, now if you're saying, okay, I owe 50,000 in credit cards, I'm in debt and I lost my job, I have no income, then that might be, get a consultation, and it might be something for you. But if you still have a job, I understand you have credit debt, don't get overwhelmed. It's just getting a strategy and a plan in place for you to fix your debt, okay, with other options. That should be like the last option before bankruptcy, if you get into a debt relief program, where you have really no choice and no income to do that. But it's really damaging to your credit. It stays on your credit. You get locked in for 3 or 4 years to pay it, and it costs it. Yeah, I don't know. Me neither. Yeah.
So if you're planning to buy a house, don't do consolidation.
Yeah, no. I wouldn't. I never do it, even if I'm not buying a house.
Literally, let's kill the patient and bring them back to life. That's really
Yeah. Yeah. And they're gonna tell you, because I get calls from debt relief companies asking me to, to bring their clients after, because you can do credit repair after, right? But we can't do it during it, because if you're doing debt relief, that means they already confirmed and already validated that information, and you agree to pay for that balance. So what are we disputing? Okay, so you can't do it during it. So after you finish that, we can try to see if we can do credit repair in terms of, are they still reporting the balances correctly? Do we see something inaccurate or things like that? Then we can catch them with the FCRA law. But you're talking down the line. So yeah, so try to not do that. Yeah, well, I know it sounds tempting. Oh, they're gonna, I only have to pay 50% of my debt because they're gonna negotiate, but all that money, they charge like 20%. It's very expensive for them to represent you and make those negotiations for you. Okay, and they put it on that in that bill, and they're locked in for 4 years. Okay, good question. Thank you. Yeah.
I see that a lot, that's why. So,
Awesome.
My little one wants to. I had a client that came in, come on, Julia, why is it debt relief program? The average person owes like 20 grand credit cards. That's nothing for the bank. So that's something that's still manageable if you guys can shift money management. Yeah, you have to put yourself into it. So like, oh my God, really, you have like 10,000, like, what is it for the loan? There's other ways of doing it. Now she has to wait 4 years for us to work with her credit. Because all those, she has like 5 or 6 of them in her credit, they all stay collection, still there.
Awesome. Any other questions? All right. Well, thank you all so much for coming out tonight. For those of you that joined us online, we're going to be following up with you. You're going to see some emails. If you'd like to schedule an appointment with an agent, let us know. We will set that up with you. For those of you that are here, we're going to be here. We have agents hanging out. Hector and Giselle will be here. We'll be here to answer any one-on-one questions that you may have, and we have plenty of food out there still. So please help yourself. All right. Thank you all so much for coming out tonight. We really do appreciate it. We're grateful for all of you. Thank you. Thank you.